What's up, guys? Today, the pros and the cons of VTSAX, because I get asked all the time, like, Brad, you're always talking about VTSAX and how much you love it. Like, are there any bad sides to it? And I got to admit, like, it's not all cupcakes and butterflies. It's not the perfect investment. There are some other ones that might be better. There definitely are some cons. So I want to go through the pros and the cons and tell you why I still think, even with the cons, that VTSAX is by far the best, at least beginner investment opportunity, but also a great investment opportunity for veteran investors as well. First, let's just give a little minor recap of exactly what VTSAX is, which actually is one of its pros. VTSAX is a passively managed index mutual fund. Now, what the heck does that mean? Let's break down what its parts are. In its core, it's a mutual fund. And what a mutual fund is, it's a bunch of stocks that come together into one fund, and then each part of those stocks contribute to the growth and the loss of that mutual fund. So essentially, the fund is built by a bunch of different mutual companies working together to hopefully make that fund go up. Now, the thing that makes this an index mutual fund as opposed to just a regular standard mutual fund is that an index follows some greater part of the stock market. For example, the S&P 500. You can have an S&P 500 index fund, which its goal is going to be to track the S&P 500. As the S&P 500 goes up, so does that fund. And the same works here with VTSAX. VTSAX is the total stock market index fund. So whatever the whole entire stock market does, when the whole stock market goes up, VTSAX goes up. When it comes down, so does VTSAX. So not only is it a mutual fund, but it covers just a standard index. And we know that over time, the stock market is going to go up. So therefore, VTSAX, generally speaking, over time is going to go up. So now what does it mean to be passively managed? Well, a regular mutual fund is what we call actively managed. And if you hear actively managed, you're probably going to want to shy away in this day and age. Essentially, the difference between an actively managed fund and a passively managed fund is with an actively managed mutual fund, there is one fund manager, and this person's job is to pick the things that go inside this fund, and they pick the percentages, and what they do is they bring companies into the fund, they get stocks out of the fund to try and get you the most growth possible. But with a passively managed index fund, we don't need to do that because the amount of the stock that's in the fund is just a representation of how big that company is. The bigger the company, the greater impact it's going to have on that index fund. And history also shows us that over time, these actively managed funds, they don't outperform the index. They might get lucky here and there, and yes, there's probably some that can do it over a 5-10 year period, but that percentage is super low. So we go with the index because over time, like I said, we are long-term investors. The index is going to beat these actively managed funds. Not to mention the fees on these actively managed funds, because we have to pay the fund managers, they're huge. So my advice is I stick with passively managed index funds like VTSAX. So the first pro of VTSAX is it's a passively managed index fund. So it has low fees, and over the long haul, it's going to outperform an actively managed fund. The second thing that I love about it is it's run by Vanguard. And Vanguard is a company that I just admire, and here's why. Vanguard is not a publicly traded company like something like Fidelity or Charles Schwab. It is owned by its funds itself. And who invests in those funds? Well, us, the investors. So essentially, the investors kind of own Vanguard. They don't own Vanguard, but they own the interest in Vanguard. As Vanguard's funds go up, they benefit and we benefit. There's no outside investors. Vanguard doesn't have to worry about pleasing anybody or getting profit to its investors. It only cares about us, the investors, and that's how they keep their fees so low. They are not a publicly traded company, and they have no outside investors to please, which is great because when Vanguard makes a decision about their fees, about their funds, and changing certain things, they are doing so strictly at our benefit. When other companies make decisions, you don't know if they're doing that to really help you or because their investors want that or because it's going to make more money for their investors. And that always kind of like sketched me out. I know that when I get information from Vanguard, it's going to be in my best interest. And that's why I love Vanguard, and that's why I love their total stock market index fund. Granted, companies like Charles Schwab and Fidelity, they have total market index funds as well, but that's why I chose Vanguard, because when they do well, I do well. And when I do well, they do well. And that's all they care about. Guys, Vanguard on their site, if you're working or have a Roth IRA right inside Vanguard, they charge a $20 fee, but that fee is waived automatically if you go paperless. So if you can get your statements via email or download them yourself and you don't need to actually get something in the mail, they waive that fee, which I think most people are doing nowadays. So there's no trading fee, there's nothing. The only fee that Vanguard charges is what they call the expense ratio. And that's how much it costs them to manage that fund. And they have some of the lowest in the game. You might be able to find some lower. I'm not saying they're the lowest, but on average, they're about as low as you can get. Their expense ratio right now, which can change, is 0.04%. And what that means is that every $10,000 you have invested, they're going to take $4 in fees. That's it. $4 for every $10,000 that you have invested. And the last pro that I love about VTSAX is that it's self-cleansing. And here's what I mean. When you have individual stocks, you have to worry about the volatility of stocks going up and stocks going down. You can have a company that's performing amazingly for years, and one bad thing happens, or the CEO does something stupid, or you find out there's a scandal, and everything can be gone, taken away from you. That stock could plummet to zero, bankrupt, and you're left with nothing. We've heard about stories like that in the past. But when you have an index fund with a ton of companies in there, right now VTSAX has over 3,500 companies in its fund, one company isn't really going to affect the total fund itself. And that's what I mean when it's self-cleansing. If one company takes a dive, there's going to be another company out of those 3,500 that's on the rise. So there's constant balance of companies going down and companies going up, which is what allows for that consistent growth over time. Vanguard's total stock market index fund started in 1992, and since then it has averaged just under 10% at 9.74%. And it wasn't until it switched to the Admiral Funds, which I'm going to talk about in 1 second, in 2000, that dropped to a more normal 7% return. And it created these Admiral shares at the time just to keep fees lower. Now, since 2000, a lot of things have changed in the investment world, so a lot of fees have come down. So there's really not too many benefits to having the Admiral Funds now, but when they did it then, it was so that they could really lower the funds as differently than their investor funds. So if you're curious, like, what do the Admiral Funds mean? In 2000, they made the Admiral Funds that were at a better price, lower fees than their standard investor funds. But now, 20 years later, all of Vanguard's fees have pretty much come down to the lowest in the industry. Okay, now let's talk about the cons, or at least the things people tell me when they argue against VTSAX. The most common one I hear is that VTSAX isn't, quote, diversified. Now, here's what they mean by that. Diversification just means having your hand in different sectors of the market, meaning let's not have all of our eggs in one basket. Let's have a little bit of international, let's have a little bit of stocks, let's have a little bit of bonds, and VTSAX is strictly a stock indexed fund. So it doesn't have a direct international exposure, and it also doesn't have any exposure to things like real estate and things like bonds. Now, the argument against that is because VTSAX is so big, over 3,500 companies, and some of those companies are some of the largest in the world, that it has something that we call indirect exposure to international markets. I mean, if we look at the top 10 holdings or the top 10 companies that contribute to VTSAX, we see companies like Microsoft, Apple, American Express, Johnson & Johnson, Google, Facebook, JP Morgan Chase, Visa. It's very hard for somebody to argue that these companies are not making money in international markets. So that's what we mean by that indirect exposure. And for me, that indirect exposure to the international markets is enough diversification for me. But if you're somebody that wanted more direct international exposure, you could just pick up an international index fund like VTIAX. And the same could be true if you want to hold some bonds. There's a Vanguard Total Bond Index. And if you want some of these great index funds, I did a video about that. I'll leave them down in the description below. You could check out the 5 best index funds that I think Vanguard has. If you think Vanguard has enough indirect international exposure, give this video a thumbs up if you agree with me on that position. Or if you want more direct, let me know in the comments below why you chose to go that route. As far as the bonds, when I get a little bit older, I'll probably start to dabble in bonds, but at my age right now, I can deal with just having VTSAX and the stocks right now, and I'll worry about the bonds as I get a little bit older. Another con I hear about VTSAX is the minimum price that you need to invest in it, and I get a question about this all the time. To invest in VTSAX with Vanguard, there is a $3,000 minimum to get into that fund. Now, once you reach that $3,000 threshold, you can invest any amount of money in any increment that you want after that, but it does take $3,000 to get into VTSAX. But Vanguard has done something incredible to help you work around this issue as well. There is something called an ETF, an exchange traded fund. And this fund trades like a stock. So you can go onto your Robinhood or your M1 Finance or whatever app you use, or you can go right to Vanguard and you can buy shares of VTI, which is identical to VTSAX, but just in an ETF form. And you can get into this ETF with whatever the share price is. Right now, it's about $170 per share. And what Vanguard will do for you if you're investing in VTI is when you get to that $3,000 threshold, they will convert those VTI shares into VTSAX for you if that's the route that you want to take. If I missed a pro or a con, please leave them down in the comments below. I want to be as transparent as possible for people so that they can get the best experience possible while investing. Right here, I'll leave a Vanguard playlist with everything you need to know about VTSAX, Vanguard, index funds, everything that I've done so far on them. And right here, I'll leave something that YouTube thinks that you'll like out of my content. Until I see you on the next one, guys, stay positive, work really, really hard, always be kind to other people. I hope you have yourself an amazing day and an even better tomorrow.